Because we have ARS has a call at 12 o'clock and we're doing a similar topic, but it's going to be that call is going to be much better. I can assure you, because my partner Arnold Schmeidler is going to be presenting. But let's want to talk today about transitioning from the Fed to fundamentals, because I think the shift we're about to undertake with the markets is going to lead us to not having central bank policy and easy money drive it, but a less easy policy coming forward. So before we jump into that, I just want to remind people what we thought was on people's minds coming into the year. And it was really obviously about COVID. We knew that there was going to be adjustments to monetary and fiscal policy. We just didn't know what the timing or the magnitude was going to be. Inflation obviously was one of the big elements that was on people's minds, and also global stability and supply chains obviously were driving a lot of what was going on. Our view of it at ARS was that the system has been so well supported, and actually excessively well supported, that we were still going to grow even with the headwinds that we saw coming this year. And that while growth rates were going to be strong, they were going to slow after we had artificially high growth last year. And also, we're not in the camp that inflation is going to be as persistent as everyone else is. That is probably the biggest area of debate in the markets today. And there are good cases to be made on either side. We're just in a period where we don't really have experience reducing balance sheets as much as we have to, shifting an economy as much as it's going to shift, and doing it in the time of a pandemic with supply chain disruptions. So there's a lot of moving parts right now that are somewhat of a distraction, but some of them are real, and they're creating a lot of increased volatility. Rates are obviously going to move up, and the question is how much, how fast, and what the end game is. But we think they're going to have to remain historically low, and that China is one of the wild cards here. And we really have to see how the second largest economy plays out this year. They're managing for stability, but there's underlying problems there that we think are going to really take hold. And I'm fascinated by the fact that Howard Marks was able to go and take what is a big stake of Evergrande, which is a sign that the Chinese might be more open to outside dollars, or it could be a sign that their economy is struggling more than they think and can handle on their own, so that they need the outside dollars, or it could be a combination of both. Either way, that's something that's going to bear a lot of watching as we move into this year. So there's a lot of moving parts, a lot of things on people's minds, but we think the big issue is that the Fed's getting more attention right now than it would ever prefer. They would like to have be less of, in the headlines, less of a political football. I just wanted to give a little background, because we sometimes lose sight of the Fed and their purpose. It was originally designed for stability of the banking system, not with the dual mandate. And managing monetary policy was not in its original design, but it did morph into that, and particularly with the Federal Reserve Act of '77, where the dual mandate of price stability and maximum employment was really defined. Term limits were part of that, and Senate approval was a part of it. They then really further defined that in '78. And obviously, this is when we're in the middle of a massive inflation run. So the issue right now for the markets is, how do we shift back to a more normal market where the central banks are not the drivers of the market, and the put comes off because the central bank has to reduce their balance sheet. They have to move to a level of normalization, but they also have to do it without tipping the economy over. And the reason for that is what you see on this chart. They have to lower the balance sheet again, but that's a long way to go, and it's going to take a long time to do that. And as they're pulling the punch bowl away somewhat, how does the economy manage to that? And the real issue for them, and it's not just the Fed, it's the ECB, the Bank of England, the Bank of Japan. It's really all central banks right now that they're worried about. How do you pull the punch bowl without creating a bigger problem than you were starting with? And how do you do it at a time, excuse me, where you're worried that the fragility of the global system is as great as it is, with debts as high as they are? So I think that's really the dilemma for the Fed. They're going to need to move in a measured pace, but how do we get past that? So our view is you're not going to get back to normal, what we've considered historically normal interest rates for some time, even with the sharp move that we've had. We think the market is going to need to digest it. We think whether you look at the Fed funds rate here or the 10-year Treasury, we're going to be below trend for some time in our view. And that's going to be a requirement that the government's going to have to try and manage the economy enough that the bond vigilantes don't take over. But I think one of the underlying things that's concerning the Fed, aside from their ability to deal with the next crisis, is the current one and the scarring from the last 20 years of really difficult once in a 50 and 100-year market events with the great financial crisis and the pandemic hitting on top of each other. They're worried about the long-term effects of scarring. And as the fiscal policy gets pulled away, they're really concerned about how the labor market manages that process. And I think what you're seeing on this chart is the red line is the U3, which is the reported unemployment number. The blue line is the U6, which is adding in the total unemployed plus marginally attached workers, plus people who are working part-time for economic reasons. And that's not a good number when you have a big number there. While it's come down a lot, it's a positive move, but we have more to go. The other thing that the Fed's seeing and they're counting on is that the labor force participation rate comes back up. And if that happens, it should reduce the wage price spiral that's going on right now, because you have more competition for jobs than the employees have right now. And that's going to change. And why do they think that's the case? Well, if you look at the persons not in the labor force who want a job, you still have 1 million people to get back to where we were pre-pandemic. And that means you do have a lot of room to move. And that's just counting the people who want a job now. That doesn't count the people who don't want a job, but are going to have to start working again because government benefits are going away. So here's just a snapshot of the employment change by industry. You can see that a big move over the last 12 months with leisure and hospitality really coming back online. And we think this is a big element of the shift that we think is going to occur that's going to reduce the inflationary pressures, because you're going to shift from goods to services and spending. And that's going to take some of the pressures off as supply chains ease and as the pandemic moves further behind us. So where do we go from here, and what does the Fed have to do? They're going to be concerned about their employment, but they're also concerned about inflation, which is why they're talking more aggressively right now. But I believe they're going to try and use a very measured approach, and they're going to try and really focus on talking the market expectations of inflation down. They went too far. That's easy to say in hindsight, but if you recall what the global economy felt like at the depths of March of 2020, you can say that they needed to act when they did, but they probably stayed a little too long, but that's easy to say now. I think there's a lot of concerns about tightening, but for the Fed, they're concerned about going too much too soon, and that they don't have the firepower to bail out the economy again, or you end up in a Japan-like scenario. The Bank of America came out just the other day and suggesting we're going to have maybe 7 increases in the Fed funds for this year. I think that's probably more aggressive than the Fed will be by a couple of increases. I still think 5 or less is the right number. And I think a lot of that depends on how the reopening goes and how we get past the pandemic. I think they're just too late to be too aggressive right now. And I think that's something the market is going to struggle with, which is why I don't think they'll go as far as the market's projecting right now. We think this has created a lot of volatility that's creating some really interesting opportunities, and we'll talk more about that later, but they're in the secular themes. We think that when you have such uncertainty and volatility, you look past the near term and invest in the stuff you think is going to work for the long term. And that means we're going to have a different pricing on the markets, whether it's private or public markets, because you're going to have a slightly higher interest rate environment, but it's the rate of change from such low levels that'll change the calculus. And if we move up too much in rates, you're going to see a lot of exposure of companies that were highly indebted that are not going to be good credits at a slightly higher interest rate environment. That's going to create a big divergence between the haves and have-nots. But we do think that the central banks around the world see debt and demographic issues and deficit issues as natural limits to their ability to raise interest rates much. And that when you combine that with the productivity improvements that are going on, we think you're going to have maybe not a great market this year, but not the big negative that some people are projecting. But a lot of it depends on, can we get past the reopening? I would say there's one other big element that I'd be curious to get feedback from people in Asia on, and that is their take on what happens with the zero COVID policy, because I heard yesterday from Glenn Grossman that he's very negative on the outcome for that for China, and that you're not getting to herd immunity, and it's going to actually create ongoing problems for them because they're so far behind in their quality of the vaccines and the efficacy of them, as well as how far they are from developing and being able to get out in a significant way the mRNA vaccines, because they're so behind on that. But it's a mixed market, without question, a mixed outlook, but there are opportunities, and I think you'd really have to focus on quality in this environment and avoid the making extreme bets, because the high multiple stocks and low multiple stocks are not going to get you the returns you're looking for in this environment. So Mark, I'll stop there and we can open up the discussion.
Stephen, this is Luke. One question, I didn't see it really mentioned, but I think one of the most significant things in the news lately is the CHIPS Act that has been, passed by Congress, but I think yet to make it to the Senate. But that alone right there, I think will help kind of shoot a boost in the economic stability in America and growth.
Yeah, chip supplies are a big issue, and it's going to be part of the Cold War that we're going into going forward. Is who controls tech and how is it controlled and how does that play out? But we think that the supply-demand dynamics are, you're going to be in catch-up for a while on that, and that this is an environment where a lot of investment's going in, but it's not going to pay off for several years. And we think the demand dynamics continue to improve in that area as well. So you're in this mode where everything requires chips now, and we're playing from behind, and that's going to lead to continued supply and demand imbalances. Even though it's a positive move, it's probably a little late for where we are. And you're going to see something similar in our view with rare earths and other areas, because you need to protect the whole supply chain for that. So I think that's going to be one of the interesting dynamics that plays out in the Cold War that we see going forward.
Other questions,
Steve,
comments?
Steve, ADP in January said that there was a drop in the labor force of 300,000. I think BLS said the labor force increased by 400,000. So that's a 700,000 worker differential. You probably addressed this before. Why does that happen? I don't understand what's happening there.
Well, it depends on it. Sometimes the numbers reported are seasonally adjusted, not seasonally adjusted. One is straight from the payrolls. One is uses other sources. So they don't have one common source for it. ADP uses payrolls for theirs. It depends on the timing of how certain layoffs get reported and the like. So there's a lot of squishiness in the numbers that I think that's one of the problems in the market today is we are so hyper-focused on the short term that we overreact to everything and need to just step back and take a breather because everything gets adjusted month out after. But you're also not comparing apples to apples all the time. And I think that's one of the issues that people get wrong and overreact wrong to the market.
Thank you.
You're welcome.
Stephen, a question regarding, well, a couple of questions. First, labor participation. I noticed that the participation had gone down from 68 to 62 over a long period of time since, yep, I think 2002. Is that a function of retirements in an aging population or technology displacing people, or what? Do you have any insight?
It's everything. It's everything. We're demographically and aging like the rest of the world is at a pretty fast rate. So our boomers are retiring and our birth replacements aren't quite as high. So the participation numbers are going to change. There's a employment to population calculation that people are using now that they're watching, and we're starting to see that shift up a little bit. But we have a couple issues. An immigration policy issue the last couple of years has also been a factor When you close the borders, the US, we forget how important immigration is to us. And particularly with all the noise around immigration and the way they're handling it in DC, they're forgetting about the economic impacts of it from how that they've driven, immigrants have driven so much of our policy. And one of the things we've focused on at ARS a lot is the H-1B visa process is so backwards in the US that we only allow roughly 85 H-1B visa students. We get about 200,000 applications for it. What we were actually doing prior to some of the tax changes under the Trump administration was we were taxing cash at such a high rate that foreign corporate cash, that we would get foreign students to the US, get educated here, and then have them not accept them back as workers here because we wouldn't give them the H-1B visas. They'd go back and compete with the dollars that were held overseas by US companies to import inflation back into the US. That was our policy. If you really step back and thought about how we're handling immigration, instead of worrying about the illegals and all the stuff that they're politicizing in Washington, we should really be thinking about how do we get the best and the brightest to come to the United States and stay here after we educate them, and create jobs and pay taxes and create new businesses. So I think we got that one all wrong. So you see a lot of sloppiness in how it's reported, but I think the immigration's one element of it. I think the aging's another element of it. So we just have to kind of work through that, and we'll all have that's where technology is going to have to step up and play a bigger role to make us more productive.
One last, well, two questions.
Oh, wait, Adam, that'll be 3 questions from you then, right?
Yeah. Rob's not here, so.
Yeah, Rob will pop up.
The interest rates also a steady decline since 2008. Yeah. And
Yep.
on top of that, the Fed needing to reduce its balance sheet. Does it really need to reduce its balance sheet?
It has to at some point to deal with future problems. You can't have the balance sheet is actually debt somewhere. And we're distorting the markets. And that's actually one of the things that we're moving from really an artificial market since 2008, 2009 period that was really supported by policies that were highly unusual, and zero interest rates being one of them, negative interest rates being another. It speaks to how big the debt problem was, but that debt problem has only gotten worse, and it's masked by the low interest rates. So we're going to have to keep rates low. And just to use the US, for example, if we were to move the current rate structure up to where it was, say, in 2001, we would add probably $600 to $900 billion to our interest costs for the US debt. We can't afford that right now. And Europe has a similar issue with their balance sheet expanding. Bank of Japan, the same thing. So everyone has to figure out how to bring their balance sheets down so you can prepare for the next crisis. But if we've taken away all the tools that central banks have to regulate the economy, which we're really starting with interest rates and quantitative easing, you're really in a much tougher spot. So they're going to actually have to get to a better rate environment so you can lower rates again for the next cycle. And you need to be able to pump money into the system if need be. So I think they have to find a way to get it down, but they're going to have to do it gradually and over time. And I think what's going to happen is a lot of the dynamics that are distorting the economy in the last 2 years, the lockdowns and the supply chain disruptions and the COVID, as that eases and gets behind us, a lot of the inflationary pressures come off. You're going to start to see a lot of the reshoring and technology that's coming into play be really starting to show up in productivity improvements. That's going to ease the inflation problem. And then you get to a better spot from there that allows the Fed to raise rates slightly and also bring their balance sheet down. But they have too many moving parts and people want too much too fast. I just don't think it's feasible.
Right. Well, that's a huge challenge. Just not only the Fed, but the European Central Bank, as well as the Bank of England, having these large balance sheets and trying to bring that down. It's going to be a challenge.
Stephen, by what magnitude do you think the Fed needs to shrink the balance sheet? Is it to pre-COVID levels of about 4 trillion or pre-Great Recession levels, i.e. 08 of 1 trillion?
I don't think we're getting to the recession levels for a long, long time. I think they definitely need to try and get to pre-COVID levels, but I think that'll take years. I think that's going to be a challenge that's going to take years. And I think if we do it too fast, you'll see real disruptions. And that's for the US. If you're in Europe and you're trying to reduce your balance sheet and you need people to step up and buy the bonds, who's going to step up and buy the bonds with your rates so low? That's part of the issue that they have there. One of the benefits for the US of having a reserve currency, the reserve currency, and higher interest rates are, when the Fed steps back from their purchases, you'll see European and Japanese buyers come in for the yield differential and the safety pickup. So I think that's going to be part of the challenge of how do you attract in other countries the dollars to replace it without having your rates have to skyrocket up, which they can't afford. So the central banks are in a spot. You're going to have to make this transition. It's going to be sloppy along the way. And that means you're going to have to focus on the fundamentals of companies. And as you do that, you're going to really start to see the divergences inside sectors and industries, how big the differences are between the haves and have-nots. And that's really where people are going to have to step up and really do the work, whether it's the private markets or the public markets. I think this is going to be one of the more interesting periods where you're going to have to be much more judicious. So when we've said in the past, you need to be cautious and opportunistic. I think the issue here is, shouldn't you be that all the time? There are times where you have to actually be even more cautious and more opportunistic because of how you play through on a environment like this. It's just too many uncertainties with really no meaningful history of tightening that's ever been done. So I think that creates a challenge. Rob, you had a question?
Hey, Steve, thanks. Your comment about sort of the return to, I guess, return to normal and, sort of onshoring and the like. What are your thoughts on some of the differing states on mask requirements, and you just have different, levels of re-engagement? You talk about have and have nots. It's not an equal playing field. So it's not going to be a smooth linear equation there.
Yeah, I wish I had the right answer, Rob. I don't think anyone's really gotten it right. I do think that I think we have to get to herd immunity however we get there as fast as we can and safely. I just don't know the right way to do that. And it's a political hot topic that I don't really have a good answer for, nor do I want to venture in to it. But it is fascinating. I think you have to get to where we do return to normal faster. And I think that's going to be a problem for China. I think that's where the zero COVID policy is going to create some challenges, which we have to keep in mind. If China slows as the second largest economy more than they're actually trying to slow now, that could have some real knock-on effects for a lot of the world. So something to keep an eye on.
I just wanted to say that, and Rob, true to form, you jumped right in there, right? So, but there in the video in Miami, there's Zoom, and then I'll just show you guys. True to form, here it is. John Najarian speaking, and Rob gets the first question, and Adam gets the second question.
So that's my opinion.
Your question was, what does his NFL preparation, how did it form his trading strategies? And what was your question, Adam?
You're muted.
I
don't remember what my question was.
Okay.
Well, just for clarification, it wasn't so much trading strategies. It was just more of the adaptability of being sort of an elite athlete, and then having both, basis and then the discipline to be good what you do in another area. I thought that was the very interesting area. And just as a sound note, I mentioned a couple folks here. I'll be at some of the Super Bowl stuff this weekend in LA if anyone else out there. So I'm not sure, Mark, if there's a 360 thing going, in Southern California.
We were going to, and then with the on again, off again, we've switched it off, but we'll do something.
Mark, I think my question to him was about the metaverse and specifically Decentraland. which is a crypto that is used in Decentraland to buy land, cars, skins, what have you. I think that's what it was about.
Fair enough. Well, everybody can watch that video and see if we,
Hey, Stephen, I got a question for you. You know, it was, I don't know if you saw the press secretary yesterday, but, you know, one of the reporters asked specifically what the administration was going to do about, you know, the cost of sort of energy prices at the pump and in the homes and stuff. And I thought the response was pretty interesting. She said that the country, she specifically said they're trying to get the United States to invest in the new forms of energy. It was the first time they were kind of justifying, let's go get our fossil fuels overseas. Let's get everybody in the US to invest in new forms of energy. And I mean, they would have been better off sort of articulating this a few years ago. Anyway, that's where we are. So it seems to me like the Western world, and particularly the US, has adopted a policy of expensive energy for a period of time. I mean, that is not just a circumstance that we bumped into by mistake. This is an intentional circumstance. It's been created by policymakers. So if you're the Fed, are you really, are you calculating that as part of your inflation? Or is this something you can look at as a one-time thing where everybody just has to pay 50% more for their energy? Because I do, you know, if you listen to the pundits on TV, they're all going to tell you, oh yeah, oil can go to 120 and we can absorb it. You know, that's the common view right now, is that energy prices can be higher and we'll absorb it. I'm not so sure there isn't a risk on this. And if I'm the Fed, maybe I'm thinking I'll calculate my inflation X energy. Anyway, I'm throwing that out there for discussion. I'm just curious if you guys have thought about it or heard any other comments on that.
It's interesting because the ECB had Lagarde had an issue with that in her press conference the other day as well, where they view the energy movements as not something they can affect change on, because it really comes down to, are people making the investments they need to bring more production on? And what you're saying is, and this is an interesting dynamic for the US, we've taken one of the real strategic advantages we had economically of energy independence and have turned it into a muted asset. And that's just insane right now. And doing this transition without the fit of both of them in both fossil fuels and renewables working side by side to affect the transition is critical. And there was an article in one of the papers today that they were suggesting that by doing it the way we're doing it, we're actually going to embed fossil fuels more into the production process along the way, because if you're not making the investments in it, you're going to rely on that for other sources until you can get to the point you want to be at. And I think we're doing this all wrong. I think you have to marry the two together and find the right way to support the fossil fuel industry to make the transition rather than penalize them. And even BP was out today saying that there's discussions of a windfall profits tax on the fossil fuel companies, and that would actually just reduce the amount of spend that they're going to be able to put towards shifting to renewables and having safer fossil fuel production, so that a lot of the policies are being put in place are completely counterproductive. So I agree with you, Duncan. It's a problem for the Fed that they're going to have to deal with. It's part of the politicalization of the Fed, particularly with some of the new people that are being proposed to go on the board. Are they trying to change the mandate from a dual mandate of maximum employment and inflation to one that adds in social infrastructure, whether it be climate change or hard infrastructure like climate change, or social infrastructure? They're trying to get the Fed's mandate to be different than it really has originally been intended to be. And I think that's part of the problem that the Fed's fighting, is how politicized do they get in this environment, and what role can they play to solve all the problems? And I think people think they can solve them all, and we realize that they can't solve employment on their own. They can't solve a lot of them. So they can only kind of regulate the inflation rates and the employment. They can't change everything that people are counting on them for. So I think we're going to screw up what could be a better transition by penalizing the fossil fuel industry in an area that they're not even getting investments from the street anymore at the same rate. So they're going to focus on, and we think it's leading to those companies being quite attractive in this environment. We've actually been adding to our fossil fuel holdings over the last several, well, Sean, you've had it in the ETF strategy for over a year, and we started adding them into our portfolios, sometime last year, because we think that more and more money has to flow into these areas because of the return opportunities. So Duncan, it is a real problem. I don't think they've figured it out right at the Fed. I don't think the Fed can do much about the near term on that. So it's not something they can actually impact. The fiscal policy could impact it a lot better.
I wanted to introduce a few other people that are new. Ann Kennedy, and I just put on the screen so people can see other upcoming events this week.
Excuse me, Mark, I'm going to jump and get ready for our call. So thank you guys for today.
I thought there was nothing to prepare for because Arnold is not going to listen to you anyways, right? He's just going to speak. What do you have to prepare for?
I have to prepare to try and bring him back on track when he's way off the slide. So
well, can you just explain who Arnold is for those who don't know before you go?
So Arnold founded ARS back in 1971. He had been working on Wall Street since 1959. He had went to NYU and Columbia, but he grew up in the non-ferrous metals industry. His family was the leading sellers of copper to Russia from the Western world for a long time growing up. He hated the trading aspect of the business, so he actually went to work on Wall Street, started at doing railroad industrial bonds and the like, and then through the 70s, killed it. In the late 70s, he was up 100% and 80% back-to-back years in 79 and 80, mainly based on taking the firm fully into the energy area. So very comfortable managing in inflationary environments, but he's really an interesting character. He's taught all the stuff I've learned about the markets and the economics. I would say 95% of it is from my time spent with Arnold. A real interesting guy. And he's also multi-talented. He's a classical pianist, has a number of recordings up on Spotify of his classical music, and has recorded several albums, and was the page turner for Arthur Rubinstein on all his US recordings, which I didn't know was the thing. But apparently there's skill to page turning that speaks to my lack of understanding about music. So but it'll be something.
So we'll see. He's on at 12. Can someone, Vanessa, can you put the link in the chat? People that want to register for that.
And if you can't do it at 12, it'll be posted on our website. You can hear a replay probably later today or tomorrow. It's worth a listen. He's fascinating. So,
great.
Thanks, Mark. Talk to you later.
I don't know if Ann Kennedy's still, yeah, there you are. And I know that we know Vonnie well. We saw her in Miami, and so maybe just introduce yourself, what you're doing, and it might play into our inclusion February 28th event, as we want to show Black and brown and women-led funds and companies.
Well, thank you, Mark. Yes, and we were thrilled that Bonnie was able to make it to Miami last month. I'm Ann Kennedy. I'm a managing director of the Sibylla Masters Fund, also known as Masters Fund. We invest in women-led diverse teams, largely tech companies and SaaS. We are growing. We are raising our next fund, and it's really good to be a part of this group. My other managing director in the general partner is Jillian Musick, who you will see from time to time. And it's just really great to be here, Mark. I really, really appreciate what you're doing, building this community and spreading knowledge, spreading ideas.
And I'll show everybody Bonnie's, thank you for that. Bonnie.
Hi, my name is Bonnie Rao, and I am a venture capital investor with Masters Fund. We focus on investing in women-led tech companies, and we are looking to grow an ecosystem of women professionals.
But you can see. Anyone else new that I missed? Tanya, we've sort of known you, but you want to introduce yourself?
Sure. I'm really happy to be here. This was great. My name is Tanya Smith. I'm a private wealth advisor at Goldman Sachs, former private equity and M&A attorney out in Silicon Valley. So I'm based here in Miami, had the chance to get to know Simon Vine quite a while ago. And then Mark was nice enough to welcome me into the fold for the Naples event last weekend or the weekend prior.
Perfect. Thank you.
Hey, Mark, this is Rob. I have a quick question for Ann, if it's okay.
Yeah.
Ann, for this female fund you're doing, is it mainly domestic U.S. On the sort of the portfolio side, and then just where are you and just generally on the fundraise?
We have, to answer your first question, we intend to invest globally. However, at the moment, with our initial fund, which we closed last summer, to prove our concept, and I'll get to that in a couple of seconds, we are investing, let me see, we're in Colorado, Washington State, and California at the moment. And also we're about to close a deal in Massachusetts. The concept is we invest using what a revenue-based funding model called Redeemable Warrants, which look very much like convertible notes, except that the line that says this will not be redeemed on our instrument, it says it will be redeemed and here's how. And we want to get our money in and out. We are non-strategic, non-dilutive. We want to prepare people for their Series A and then be off the cap table. So yes, as we grow, we will, as we grow the fund that we're raising now, we will begin to invest internationally. And they're women-led, but we believe in diverse teams with both men and women on them, because we think that makes a stronger, more profitable company.
Thank you.
So I just introduced you to a women-led company with revenue, because I know you like revenue.
Yeah.
As does Christian. He's on the other side of the pond doing venture debt. But that's structured debt, you're structured equity.
Exactly. Very similar, but different.
Yep. Julie, you just came on to say something?
No, I just joined to say hi.
Okay. Good. Mark White, I saw you. Did you see that we're going to go through Des Moines? We're going to go from Omaha to Des Moines.
Yeah, I'm interested in how you chose to stop in Des Moines.
Well, I'll just show everybody. You tell me who wouldn't come to this conclusion if you see this. This is the coordination committee memo for the Chicago event. I mean, thanks to Juana, I'll just throw it on the screen again. Oops, wrong. Yeah, this is it. So I mean, look at this map. You can hardly see it, but this is Omaha. This is Chicago.
Right.
Well, should I go down or should I go through Des Moines?
Well, if you're going through Des Moines, I can certainly help you pull something together.
So I'm counting on it.
Although I'm most focused on, and I'm going to get some materials out today and get them on the Chicago Midwest agenda about coordinating the effort in Ann Arbor around deep tech and science tech and the challenges.
And John Dennison,
commercialized.
John Dennison was on. I don't know if he's still on. So he's on board for that.
Yeah, I talked to him about 2 weeks ago and intending to reach out to him again today. So John will be very helpful.
Okay. Good. And again, if no one knows, I'm at Denison today, like in Ohio. So we're excited for that committee, which is a different group. Like if you go to Ohio 2022, you'll see the agenda. You can register your interest. And we're trying to figure out pickleball in Cincinnati or Granville. So you'll see it's coming together. We'll definitely have one baseball game and maybe two, because we'll have the Rock and Roll Hall of Fame and we might go to a baseball game that night. Anyone else new or otherwise want to chime in? There was a nice picture of you, Eddie, in Cincinnati It's another tradition we have to keep up, to go to Penn's, where they have one ping pong table that we took over.
That's good.
What about the Bengals here, the Super Bowl with Cincinnati, Eddie or Mark?
So in Columbus, you sort of have to divide your loyalties, but I became somehow a Reds fan and a Browns fan. So I did, but of course the Bengals would be my number 2 team. Uday. But you see that guy is, what did he bet? 4.5 million on the Bengals. So we're rooting for him. Anyone else?
Mark, I'll make a comment quickly about the 28th event.
Yep.
So yeah, Cedric and I are putting together some agendas, and be looking forward to have everybody on the call tomorrow. If anyone is interested, to please reach out to me directly. I think I've sent a couple messages privately to individuals. Jacob Lebo at Gmail. Looking to get potentially some speakers, and of course participants as well. So very happy for everyone to join. Doing some things offline, and then we'll have the planning call tomorrow as well. So thank you everyone for your support in this on February 28th.
And then leading up to it, what I told some others, Jacob, if anybody, any manager, and for that matter, and you, I want to actually do a quick interview, and we just want to shine spotlights on those managers.
Happy to.
Yeah, I did a practice run on the video this morning as well, Mark. So I'll try to get one out on my side as well, for these spotlight videos.
And you could do these interviews. I don't have to do it. Or we can do
thank
them
you.
together.
No, I'm happy. Yeah, happy to do it. Happy to do it.
Perfect. Hey, Adam, since we've been talking about Ukraine before, and now given what's happening, do you have any insights there, or should we bring somebody on quicker?
Look, I'd love to put something together in the next few weeks or 4 weeks. My view is I don't think he's going into Ukraine. It's going to be costly for him in many respects. It does seem like the EU and the US are coordinated and on the same page. But I don't think he's going in. It'll be costly, in not just the sanctions, but once the body bags start heading back to Moscow, he has issues with civil unrest and within his own inner circle, as well as the oligarchs. What use is it to have, $20 billion and you can't see your football team in London? Yeah.
So Adam, what's his point? Was he just feeling his oats, or just?
I think, excuse my vulgar, but it's a bit of penis envy. Yeah. He has always he is part of the Soviet culture. He's of the Soviet generation. One has to keep in mind that Russia really felt humiliated in the 90s. It was a humiliating time for Russia. They were on their knees. And when you look at Russia today versus Imperial Russia and the Soviet Union, it's a fraction of its size. So your sphere of influence now is small. You're no longer on the global stage. And the only reason you're on the global stage is because you've got nuclear weapons. Let's face it. The pretext for any invasion or any incursion, well, let me back up. There's already been an invasion, okay? Eastern Ukraine and Crimea. He would like to keep those as they are, I believe. Any pretext for any other invasions would be to protect our people, and I put that in quotes, Ruski Mir, which is the Russian world, Russian speakers. You have them in Estonia, Lithuania, and Ukraine and even in Kazakhstan. That move into Kazakhstan was not coincidental. Yeah, that was to show the other Soviet Republic countries that Russia does have sway. And Tokayev, who is a former Soviet diplomat, now president of Kazakhstan, he's playing his cards right, making sure that his big brother in the north is happy, as well as Chairman Xi.
So Mark, I could hog the spotlight too and ask a bunch of questions. So Adam, what's his face-saving endgame?
That's a good question. I have noticed in Russian media that the hype in the national news station, Первый канал, first channel, the hype has been dampered quite a bit in terms of Ukraine being the boogeyman and the West being the boogeyman. The fact that he has had meetings with Putin, now he has, I'm sorry, with Biden and with Macron and with NATO, that is demonstrating that he's got their attention. That's the only face saving really that I can see right now.
Makes sense.
Okay.
This is Greg. How are you?
Yeah, Greg.
What I find really interesting about this is the way that the situation is being portrayed in the US and UK press on the one hand, and the continental European press on the other.
I would agree with that, Gregory.
Which side would you venture to say is closer to the reality?
I don't think it's black and white. Yeah. Putin is certainly testing NATO, testing how united NATO is and the European Union. I think the Ukrainians, obviously, they weren't happy about imminent invasion, because that does unsettle the population. But it goes a little bit more than that. They also know the cost on Russia, on Putin in particular, of an invasion. In fact, I think that Putin has united the Ukrainians as a country more than anyone has.
Adam, I think the question was different.
Yeah, okay.
Basically, it's sort of like maybe countries where like Austria, Germany, and Central Continental Europe, how they're reporting this versus the U.S. and the UK. I mean, it's very interesting. When Merkel stepped down, she would take on Putin, and now the Germans give 5,000 helmets.
Well, there is a difference, obviously, in leadership there. Merkel understands Putin. Merkel's East German. She understands that. The psychology there. I don't think the Ostpolitik is more of let's keep the boat from rocking. Yeah, there's a lot of investment that the Germans have in Russia, and there are a lot of dependence that they have on Russia. So I think that is really more, look, they don't want war. Nobody wants war. And the saber rattling does do a lot of harm.
Well, maybe on that note, I've got to go switch Zooms to watch Arnold. He's a really interesting guy. I can't remember how old he is, 85 something, maybe 86. Really interesting guy to, he's seen a lot of cycles, and really you have no idea what he's going to talk about because he has no script. So he's just going to go for it and tell you how he sees the world. We'll be here tomorrow at 10:30 group meetups. At 11 will be a deeper fully on the Midwest tour segments. And then Thursday in the city, those who want to come at 10 o'clock for the tech debate at ARS or Zoom, followed by lunch. And then next week, yeah, future of work, when we're trying to work in education 3.0, travel tech, mental health, the other one, seed investing, and future of Europe and European venture. Those will be the next events that we'll be doing. I don't know if I told you guys, we might be doing an event on June on the Intrepid, which will be interesting, June 15, 16. It'll be after the Ohio tour. And we're looking to be in London and Monaco, September 21st, Monaco 22nd, 23rd. It's all, I think, in that, should be on that sheet that's in front of you, but thank you, everybody. Wish me luck to find the pickleball racket and pickleballs here, Columbus, Ohio, but we'll tell you about that tomorrow. Thank you. I'll be in touch with some of you on other fronts. Take care.